Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope I am audible to you. Let me do the Asian Session Live Market Analysis webinar on 19th of November, that is today, between 5 and 5:45 GMT. So I'll be giving the expected market moves based on the algorithm for the period 19th to 23rd November. And on a daily basis, I am giving the expected market moves in iknowindices.com/blog and also in fxtrade.net. So that is nothing but the derived forecast. So statistically derived forecast is bound to have certain amount of error. So we fine tune it with the help of market reading, because the volume variation happen in the market from time to time. Suddenly the traders sit on the side walls and sometimes actively they participate in the market. So you will find the variations with regard to the volume from time to time. And also the herd of traders, those who are holding already the positions may not add positions, and fresh entrants might come into that market from time to time. So we will be able to understand that with the help of the live market quote page. So the quote page is shown here, and in this you come across the four majors: Euro, USD Yen, GBP, USD CHF, USD CAD, and Australian dollar, the commodity pairs. So in this you come across the bid and the ask. The spread between that is also shown as 2 pips, 3 pips, etc. And that is the variation you come across with regard to the market quotes. So when you want to sell, you can sell it at a lower level. When you want to buy, you have to buy it at a higher level. That is why it is referred as a spread. Then you find that around 3:30 GMT, they set the initial high and the initial low, and also you come across the net change, which indicates how far the market has moved either in the positive direction or in the negative direction from that of the previous day close, that is Friday close. When US session gets closed on Friday, based on the last 30 minutes of trade, the interbank treasury derive at the closing price. From there, how much of pips Euro has gained or how much of pips USD Yen has dropped, those things are indicated here. And this acts as a vital tool for us, because the banks have got the limitations. They cannot continuously rise or continuously drop Euro, GBP or USD Yen. They have to make volatile moves, and that we will be able to understand. Besides, we will also be in a position to understand whether they are making the USD gaining move or the USD weakening move or a contrarian move with the help of the net changes. Then you come across the GMT time frame, which is very essential for us to follow, because market is 24 hours from 0000 GMT to 24 GMT. The market functions. Then the next day starts again. They set the initial low and the high around 3:30 GMT and continue the moves. So basically what we need to understand is these are tradable levels, but not the actual conversion levels. The actual conversion levels differ from that of the market levels, because the banks, in order to safeguard themselves, they try to give 200 to 250 pips above that of the ask if you want to buy a currency, or 200 to 300 pips below that of the bid in case if you want to sell a particular currency. So that much of leverage they have, so that they can take the currencies from you and put it in the market and try to earn out of that. So this is how you find the market is being structured. In this, you come across the 4th decimal level and sometimes 5th decimal level. The positions are being traded. But in the actual currency conversions, you find that only the 2 decimals are going to have an impact, because when Euro goes from 1.27 to 1.28, there will be a rise of only 1 cent. So that you can understand. So they just expanded the currency conversion to that accurate level, and then they try to use that as the pip change. So this we need to understand so that we'll be able to really appreciate what is happening in the market. In order to understand the market, first of all we have to understand the structure of the market, how the market is being structured. And you know that when you carry a position to that of the next day, they charge overnight interest. The platforms charge overnight interest. And so that we will not be in a position to carry the positions to the next day unless and otherwise we are willing to pay the overnight interest. Besides, we also deposit a margin, and that based on the leverage, whether it is 1:50 or 1:100 or 200 or 500, whatever it is, accordingly the margin is being taken from that of the equity what you deploy in the trading platform that is used to take the leveraged positions. So our equity determines how much of positions we can take at a given time. So if we have got a very less equity, then probably we may have to take only one position and try to book profit in that, or just cut loss and later on think of another position. When you cut loss or when you hold a negative position, then immediately the margin is taken. Additional margin is taken from that of the equity, and that creates the fear for most of the traders. So there you need to understand one important thing. If we take more positions, then more usable margin will be taken out from our equity, and if we take very less positions, then less equity will be taken out. And some may ask that if I take a very less position, then my profit potency is also very less. Yes, that is true. In a leveraged market, when you take only about 1 to 2% of your equity, the positions, then when the market comes down, your equity will be able to withhold the position, because predominant of the traders try to trade without a stop. So when they reverse the market and go up profit, so in this volatile market, because they purposely make the market volatile using the rumors, data release, speeches, etc. So we need to understand that any given time, suddenly when the volume builds up from that of the traders, the market can bring in more volatile moves. So ultimately, why such volatile moves happen? Because it depends upon the pending positions of the traders. The players try to hit the stops. So if the traders are predominantly long, then they just drop the market very quickly. That's what happened on Friday. When all turned long, then they dropped it quickly using some rumor, and immediately we found that predominant of the traders have just cut the position and turned short, being Friday, thinking that it will be an extended downward move, whereas they just gained back the levels. This is how they just try to play around in the market. So we should not go with that of the sentiment which is created in the market. So in such a scenario, when you take a very less positions, you will have the capacity to hold even if they drop about 200, 300 pips or 500 pips. Then the fear is not gripping you in the event if you trade without a stop. Then when the market moves in our favor, you will be able to book profit. That is what many of the traders think. But sometimes you find during the month in time they make a very big drop or a very big rise, so they can bring in the margin call. So the market is structured in such a way that if the trader is holding a position for a predominant of time, then invariably he may not be able to book sizable profit. Instead, it might be a loss, because the herd of traders taking the position plays a vital role in the market, whether they are taking the sell position or the buy position, and in which currency they are holding the positions. Those things are very important, but we don't have an access to find out how the traders are really positioned in the market. But the players have got the capabilities and they have the resources to get that information, and they make decisive moves in the market by dropping or rising a particular currency. They know very well the country will not intervene. Besides, that is not considered as an insider trading. So they play it in such a way. So we need to accept such conditions and then try to take positions. I have been telling many times that in the market, when they are holding it at a stagnant level, there is no point in taking position, because during the session start time and the session close time, they suddenly bring in volatility. So if you are a smart trader, when they bring in volatility, you try to take positions. If they quickly make a drop, understand quick moves or false moves, and then try to take a buy position and keep stop to limit the risk of 20-30 pips. Then once the position makes profit, keep stop at entry and then try to maximize it using a trailing stop, so that you don't miss any chance, because in fraction of a second the market can suddenly bring in the moves, and if you don't have the trailing stop to protect your profit, and the position might again show loss. So keep that in mind, that market has to make swings, up and down moves, and that is part of the game, and in that we are trying to capture some profit. So when you want to capture some profit, we should not miss the opportunities. And for that, what you have to do is, without taking position, you calmly wait and see whether the market is closer to that of the low or closer to that of the high. Only when they come closer to that of the low, you watch whether it is a late session or the early session, and then try to find out whether they are going to breach the low and go below or not. So if in 30 minutes of time frame, if they come closer to low and not breach the low, understand that at the higher level the traders have taken the sell positions, and the players do not want them to book profit, and quickly they wanted to take it above that of the high. So they make a pretension as if it is going to drop, so that those who are having the position out of greed, the sell position out of greed, calmly wait and expect to maximize the profit, expect the data release to come and things like that. And after coming closer to that of the low, in the next session, in a fraction of a second, they just quickly go above that of the high and trap the short sellers. So in the market, if you watch carefully without a position, you will be able to understand that the players trap alternatively the long holders and the short sellers. So in that, what you need to understand is, if you try to do a breakout trade, once they breach the high and stay above, then try to do a breakout trade. Necessarily you have to keep the hedging order or the stop at entry. Otherwise, they just break the high and stay above there for about 30 minutes to 2 hours and then drop and go below that of the low. So then you will be tempted to do a short selling after the drop below that of the low. Then they reverse the market in 1 or 2 hours and then try to take it closer to that of the high. That is what they are trying to do it, because they found that many of the traders are doing the breakout trades after using technical analysis, finding that the support turns, resistance, etc. So depending upon the trader's strategy, the players also modify their strategies. We have to keep it in mind. So this acts as a vital tool for us to understand the market. It is a man-made market, so we need to necessarily read the intentions of the players. That is what I refer it as the market reading. So we note down the initial high and the low set around 3:30 GMT in the 4 majors and 2 commodity pairs, and later on we try to use them as the reference level throughout the day and identify the types of moves in sequence they make in the market. So these two are vital factors. The types of moves, namely the stop and false move, extended move and the intentional move. Besides, they do during mid sessions the swings. Then the sequence, in what sequence, whether a stop and followed by a swing and then intentional move, then a stop and followed by a swing, an extended move. Whether they do it that way, we need to identify with the help of the session time frame used by that of the players. So here in this sequence, what we try to understand is, invariably they make the extended move either on the upside or on the downside. Extended move will be staying below that of the initial low for 2 hours maximum and then reverse the market. So they just drop and hold below the low for 2 hours, then reverse the market, make a small swing up to that of the high, Then afterwards they breach the high and quickly gain the levels step by step. So an extended move will be alternating with that of the intentional move. So once you find that intentional move which happens for 2 sessions and the start of the 3rd session, then we know the intention is to rise the market upward. So when we know that the intention is to rise, then every dip will be a buy opportunities for us. Instead, if you go into that of the charts, invariably we will find that the support is turns as a resistance, so we tend to sell when the market is near the low. Then afterwards we get trapped. Then after the rise, if we try to buy it, they may make a small dip to hit your stop. Then you think that buy and sell will not work in the market, it is better to go for a sell. But ultimately we have to understand how the players are doing the trades. So the players sell near that of the high, buy near that of the low. They are doing sensible trades. So how, but the market has to go to that of the high, only then they will be able to sell. So what they do is, they do the circular trades and gain the levels in the market. Because anybody can ask a question, when the chart is say that 1.2774 is a resistance, who is the fool who is buying there to establish the particular trade? But they are not fools. So they try to rise the market and set the high. At that time they build sell positions and then drop the market and come closer to that of the low and buy it. So at that time the traders who have got the buy position liquidate their long position, thinking that they had just taken it out of emotions at the highest level for the day. So these are all the perceived levels. So you know that Euro was trading around 1.20, 1.22, 24, 26 and things like that. On Friday, you know, 1.2691 was shown, and if you perceive that it is the low, depending upon the high they are set on Thursday, 1.28. Otherwise, if you look at that of 1.20 or 22, then you will find that 1.28 is a high, afterwards the market is expected to continuously drop. When you refer to that of the long term, invariably we will perceive differently. But ultimately what the players do it, intraday swings. They are trying to trap only the traders who are holding intraday positions. Those who are holding long positions like or short positions for a prolonged period, and they are not influenced by the small swings in the market. But what we do with the help of the 200-day moving average or 21-day moving average, we try to see what will happen to that of those traders holding such long position or the short position. They will come for the selling once they find the market has reached their level. That is what we presume. But in a leverage market, and when you have to forcibly pay overnight interest, nobody is going to hold the position for a prolonged period, and that might be only 1% of the total trading volume. So obviously the players are not there to bother about them. They only bother about the intraday position holders and try to trap them. And similarly, those who are doing the currency conversions, converting euro to US dollar to euro, they are not shaken at all by the market moves, because there is no leverage with regard to their currency conversion, so they can afford to wait even for 1 year for euro to rise to 1.40 and convert it back. So they are not in a hurry to liquidate the market. So we may think that it is a demand and supply market, but actually in the intraday moves you do not come across the real demand and supply. Instead you come across only the artificial demand created by the players and artificial supply created by the players. So that we need to understand there is a difference with regard to the actual market. So that is how the players are in a position to earn money from that of the traders predominantly who lose money in the market. When they try to use different type of strategies, different type of technical analysis and fundamental analysis, still they lose. Why? The question is, the players have got a different objective and they don't go into that after such deep analysis. Instead, they hire people and ask them to give such analysis free of cost to that of the traders through various websites and through various banks, etc. But they finally find out whether the traders are net long or net short. Accordingly, they make the moves in the market. So we need to understand. Now, after understanding the sequence in which they are going to make the moves in the market, we can enter into the market whenever there is a quick move happening in the market. So when they quickly drop below that of the low as a stop and for 30 minutes, less than 30 minutes, we can take a buy. Still, our reading can go wrong. So we have to necessarily use the stop or the entry stop or the hedging order if the hedging facility is available. So once they show profit in our buy position, then we can keep stop at entry and eliminate the risk of losing money. Then later on, when they rise the market, you trail the stop and protect the profit, and you also trail the limit upward. So either the market can hit your trailing stop or the limit so that your profit is protected. That is more important in trading strategy. Whatever be the type of analysis we try to do it, ultimately protecting the profit shows your remarkable ability to earn money from that of the market. It is nothing but a calm trader will be able to do that, and if a trader is impulsive, then he is immediately disturbed by small fluctuations in the currency moves. Then he goes for distress trading. So after the drop, holding a long position, he thinks that the market might make a deep drop and then liquidate the long position. Later on, when they rise, he repents and say that, can I buy again? So this sort of confusion should not happen in one's mind. So if you read the intentions of the players, they are bound to do the downward stop and upward stop and alternatively during different sessions of the day. Now coming to that of the live market code page, let me also refer it to that of the initial lows and the highs. Simultaneously, I will try to do that, reading the live market code page as well as the initial lows and the highs. You find Euro has formed 1.2740 as the low, 1.2774 is the high, and they are not breached, both of them. And in the case of GBP, 1.5882, sorry, 83 it was. 83 was the initial low and the high was 1.5923. So after setting the initial lows on the high, you find they are not breached the high or the low in the case of Euro and GBP. And Euro is making 19 pips positive net change and GBP is making about 35 pips positive net change. You know that on Thursday and Friday they made a big drop in the case of GBP. Many would have thought that because of the recession in UK, GBP could go further down, but whereas they started gaining more level when compared to that of the Euro. So we need to understand the sentiments are short-lived. Whatever the sentiments they create, they just hold it for about a few hours and later on change the sentiment. So we should have the mindset to change quickly our market sentiment, otherwise we'll feel to do selling when they are rising GBP. So they are not breached the low or the high in the case of Euro and GBP. In the case of Yen, 81.13 is the low. Initial low was 81.17. They came down to 81.13, made a downward stop and 81.59, which is intact. So what they have done is they just breached the low in the case of GBP by about 4 pips, and then subsequently currently they are holding around 81.16, 81.18, around that of the low. So they may just to do the weak beginning false move of small drop in the case of USD Yen, because some might be holding the long positions from 79.80 level thinking that USD Yen they can maximize the profit, and if they don't use the trailing stop they may show their entry level again. then they will just stop out, and later on they just gain again the levels in the case of USD yen. So this is the trick they do it. You have to understand. Then in the case of USD CHF, 94.39 is the low, 94.56 is the high. They are not breached. So in the case of majors, only in the case of USD yen, they just breached the low and staying around that of the initial low, 81.17. So this is the mid session, 5.26 for 5 hours and 26 minutes GMT. So which indicates that during mid session they are trying to handle the crosses of yen by making a small dip. If you refer to that of euro yen and GBP yen, they are expected to make a dip like this. Then later on, then you come across the commodity pairs. In the case of USD CAD, 99.98 is the low and 1.0018 is the high. 14 pips negative net change is seen. So they are just hovering around that of the parity on the upside as well as the downside. They are not breached the low or the high. Australian dollar, 1.0348 is the low, 1.0378 is the high. They are not breached. So in all the pairs, if you carefully see that they have done only about 20 to 30 pips spread, or 30-40 pips. So only in a pair they are done more than 40-50 pips spread. You try to enter into that currency, then you will be able to come across volatility and able to book profit. When they are near the high, we can take a sell. When they are near the low, we can take a buy as a normal basic trading strategy. In the event if they breach the low and stay below there for more than 30 minutes, then you can take a sell below that of the low, but try to close it. Try to keep stop at entry in a breakout trade when they make a small dip, so that you won't be knowing initially whether it is an extended move or an intentional move to maximize the profit. If it is an extended move, it will be a downward move very quickly, and then they just stay below for 30 minutes and then make one more cut of the low. And third time also they may cut the low, but it might be a few pips. Then you have to quickly book profit. That is a technical trade. Similarly, if they breach the high and stay above there for more than 30 minutes in a session, you try to keep stop at entry. Try to take a buy above that of the high and keep stop at entry. And once they gain the levels, you trail the stop and protect the profit. Especially when you are doing the breakout trades, don't hold it beyond the day. You try to close the position within the day, because they have to necessarily make an alternative move to that of the extended move to that of by intentional move, then again an extended move and intentional move. So alternatively they will do it, so you may not be able to hold the position for a longer time frame unless and otherwise you use the position trading strategy. Coming to that of the forecasts for this particular week. Today is 19th, so week beginning false move is expected during that of the early European session, followed by that swing and rise moves are expected during that of the European and US session. Tomorrow 20th, the start of the day, there could be a dip during Japanese session, followed by that either way volatile moves. As I explained previously, on Tuesdays nowadays they are doing either way stop ins. They are expected to make an upward stop and a downward stop and alternatively in this particular day. Tomorrow I'll explain whether they are going to do the upward stop and first or a downward stop and first. Then accordingly you can take positions. Then 21st November, Wednesday, they are expected to make initial rise during the Japanese session, followed by that of swing and rise moves during European and US session. Then 22nd November, Thursday, initial dip is expected during the start of Japanese session, followed by that very quick moves. Upward moves are expected during European and US sessions. Then 23rd, Friday weekend, they are expected to make the swing and quick rise moves during Japanese session, but volatile moves during the European session. and then quick rise during US session are expected. Then next week, 26th to 30th November, that will be the last week of this month. You know that last week of the month and the first week of the month, they are expected to bring in more volatile moves in the market. So we have to trade carefully. If you have got lesser equity, then avoid taking positions during that time, because they are expected to suddenly bring in very big volatile moves, either on the upside or on the downside quickly. Then we need to protect our position or protect our equity. So that you have to focus and try to preserve the equity. Then today, the expected market moves, swing and slide moves are expected during that of the Japanese session. They formed the initial high, and afterwards they are not breached, and they are holding closer to that of the high. Slowly towards close of Japanese session, they are expected to make the slide. And people might think that okay, Euro and GBP are becoming weaker, and then they might do a sell and buy trade, but they may come closer to low or make a brief downward stop and then start gaining the levels. So best thing is, instead of doing a sell and buy trade, wait for the opportunity when the market comes down and see that they don't breach the new low for 30 minutes and try to enter into the market buy position. You will be able to book profit during the next quick rise in the market. So during the early European session, one can take a buy and quickly book profit during that of the rise, and again during the swing in US session, you can take a buy and book profit during the gaining moves. So aggressive gains may be seen in all the majors and commodity pairs in this week, and frequent contrarian moves are expected to handle the crosses. Now, when they try to make aggressive moves, it may not be equal quantum move. In the case of Euro and GBP, you have to keep it in mind, and they are handling Euro GBP heavily. So suddenly you may find that Euro is gaining, GBP is holding like Friday. Then afterwards GBP is gaining, Euro is holding. That is mainly to handle Euro GBP cross. Euro GBP cross, if you see that they are holding around 0.80 and 0.8050 level, and they are building sell positions. They are expected to bring it down to 78 level, 0.78 level. And similarly, in the case of Euro CHF, they are holding around 1.2053 level, and they are expected to take it to 1.21 and 22 level very quickly. So if you carefully understand, when Euro was around 1.2728, they were not holding USD CHF around 94. They have been keeping USD CHF around 92-93 level. Slowly they are gaining the level if you see the long-term chart. Similarly, in the case of USD CAD, slowly they are gaining the levels in the long term. So they make less drop and more gain moves in the case of the denominator currencies. Already USD yen move has become visible. It has come to 81 from 77, 78. They have been slowly gaining the levels, accumulating the positions, and every level they just make small swing, lighten their position, and again buy it at a higher level and try to rise it. That sort of moves they are doing it in the case of the denominator currencies. And as far as Australian dollar is concerned, you know that it went up to 1.04, almost close to 1.05. Then they dropped it to 1.03 and below that briefly on Friday, and again started gaining the levels. So it will be in a range of 1.02 to 1.05. Sporadically they may just breach those ranges. So you sometimes find that Australian dollar looks very strong when compared to Euro and GBP. Later on you find Australian dollar is lagging behind. That sort of moves they are expected to make it in the market, and they are expected to gain more levels in the case of Euro and GBP, but in the case of Australian dollar, another numerator currency, they are expected to bring in the wide range swings. So don't apply the same rule for all the currencies, and the denominator currencies are also expected to gain level. You can see that Euro has gained about 20 pips now, whereas USD CHF has made only a dip of 10 pips. Australian dollar has gained about 33 pips. In the case of Canadian dollar, it has dipped only 14 pips. So they are not making the same quantum of drop on the rise in the denominator and the numerator currencies. So that we have to keep it in mind and accordingly take positions. Okay. Let me answer to the questions which are asked in the chat window. Mohan Kumar, on Friday, Euro breached the low and stayed more than 2 hours and continued on same slide. So today, what kind of move is expected? See, Euro closed around 1.2741 on Friday. They came below 1.27 and then gone above during the late sections. So there was an extended move followed by that of that intentional move now. Sorry. Then money magnet. What are the new daylight saving? Asian session. Oh, okay. With regard to the market timings, it is displayed here. Once the daylight saving system is off from the 4th of November, you find Japanese session is 0030 to 7:30 GMT. Then 7:30 to 8 is the gap time before the start of the European session. So European session is from 8 to 14 GMT. And 14 to 14:30 GMT is the gap time before the start of the US session. 14:30 to 21:30 is the US session. Then 21:30 to 0030 is the gap time before the start of the Japanese session on the next day. These are all the timings. Still, we will note down the initial lows and the highs only by 3:30 GMT. Did you say that it is best if the opening range is at least 40 plus pips to take a position? Yes, right. Otherwise, just wait. You are absolutely correct. Because when the range is very less, they are not expected to make any big moves in those currencies. If you see in Japanese yen, and also CHF, many of the days they have been keeping around 10 to 20 pips. And now you find the USD yen is making nearly about 40-45 pips spread between the low and the high. So after making a brief downward stop, they are trying to take the USD yen on the upside. At that time, they may make a small dip in the case of Euro and GBP during that of the late Japanese session and also start of the European session, and a small dip in the case of Australian dollar, but it may not make a breach of the low because they had done it already on Friday. So this time Australian dollar, they will try to rise more. How? Because you find the pip change is more, 33 pips, and in the case of GBP 35 pips and Euro 19 pips. So the currency which is making more pip, they will try to hold. The currency which is making less pip change, they try to make a dip. That's how they do it. If you carefully watch it, you will be able to understand. The net change gives a vital clue for us, because whatever be the hidden agenda, they may get that information from interbank treasury, but they have to expose it in the market at one time or the other. And what happens most of the time, the indicators become lagging indicators. The indicators later, about 10 to 15 minutes later, you find that this is what happened. But that is of no use for trading decisions. So if you look into that of the net changes, you will be able to find out quickly what sort of moves they are trying to do it. And they have to necessarily do the upward and the downward stop in a given day, and also the swings during mid sessions in order to handle the crosses. And that swings might be a drop in GBP, rise in Euro, or a drop in Euro and rise in GBP, that sort of contrarian moves. And Then you come across a false move during that gap time. They try to make a rise in order to make a drop during first 30 minutes of the next session, or they make a dip during the gap time and rise during first 30 minutes of the session, and then bring in volatile moves, and later on they make either an intentional move of two sessions, and the start of the third session they continue to rise, but that will be a very slow move. You can differentiate the intentional move from that of the extended move with the help of the momentum study. If the momentum is very slow, pip by pip or 2-3 pips at a given time, then understand it is only an intentional move. You can simply wait for 2 sessions before making a short selling on the upside or making a buy on the downside. If it is an extended move, it will be a very knee-jerk reaction. Like on Friday in Euro, they made the quick rise up to that of the high. Without breaching the high, they made the drop and cut the low. And that is a typical false move followed by that of the extended move. After the extended move, the late session, they started gaining the levels. So they have the mechanism to handle the market. If you understand their mechanisms, then you find it easy to trade and earn money from the market. Then money magnet. So 3:30 GMT is still this. Yes, it is the time we have to note down the initial lows and the highs. Any more questions, please? If you got any questions, then I am willing to answer. On Thursday will be holiday in USA. Is that, will there be an impact? See, whenever there is a holiday in any particular country, if it is during that of the week beginning, then probably the volume might be low. They may not make any big moves. But if it comes during the mid-week, then invariably what happens, they will try to make the big moves because already the traders have committed positions, and in order to hit the stop on the upside and the downside, they have to make quick volatile moves. So at that time, even though it is a holiday, you might find the market is making swings. Then you will find that explanations that even though it is a holiday in US, the other traders from other countries are actively participating in the market. So ultimately, the attributes continue to pour it in the market. So attributes are nothing but the excuses, whereas the actual reason you may not be knowing. So we are only expected to know only the attributes. So it might be downgrade story, sudden rumor and things like that, which can act as an attribute. But you know, on Friday, Euro made a quick drop and reversed in a matter of about 2-3 hours. During the late session, they gained again levels, and GBP also dropped and hit the stops below that of the low and then gained again. Why you should gain it in a matter of about 2-3 hours? So if you analyze all those things, you will be able to understand that they have been working on the stops. Then taper. Okay. Yeah, no more questions. Then let money magnet. So the major or the commodity pair that is moving the least will be the one that will move the most once the market reverse. Yes, you are right. I explained many times that the currency which has shown lesser negative changes will move first to the positive zone. Similarly, the currency which is making the more positive net change will make first upward move, followed by that of the other currencies. So that is how they make the moves in order to handle the respective crosses. Okay, I'll come to the last slide. Okay, I take this opportunity to thank FX Street and also you people who have come here to attend the webinar. And this week, I'll be presenting the Tracking the Forex Market Together Part 1 and Part 2 webinar. Part 1 by 9 GMT and Part 2 by 15 GMT. So 15 GMT will be 30 minutes from the start of the session, so you can follow it, how exactly the position can be taken based on the market moves. And I will explain to you the type of market moves they are making it and what could be the next move. Based on that, I will try to take the position. You can watch it. And if you find that this method is useful, you can also try it in a demo trading platform first, and if it works well, your understanding is better, then probably you can put it in your real trading account. So on 21st I'll be giving Tracking the Forex Market together webinar, mainly with regard to the trading strategies. So in these Asian sessions I give the market analysis, what could happen with regard to the various currencies and the expected market moves for the various days. Then on 22nd, the next day, Thursday, I'll be giving the Asian Session Live Market Analysis webinar around 5 GMT and try to review the forecast what I have given it in this particular week, that is on 19th today, and review it around 22nd, what happened to the forecast and what happened to the market moves, and try to give you the forecast for that particular day and also the weekend, what are the expected moves for the weekend. So on a daily basis I am giving the forecast in the blog without the levels. So the levels you have to determine based on the type of moves, and also on a daily basis you note down the initial low, the high, and you can understand whether they are doing the stop end to take a buy below that of the low or a false move up to that of the low and try to take a buy. Those things you can easily understand. And also I post it in fxread.net. There again you can follow it. Any doubt you can ask questions there. I am willing to answer those questions. If you want to personally send email, you can note down my email ID and ask for some explanation. Thank you one and all. See you on Wednesday.